On behalf of Motilal Oswal Securities, I would like to welcome you all to the Q4 FY18 conference call of Godrej Consumer Products. We have with us the senior management team of GCPL. Over to the management for opening remarks, which will be followed by the Q&A.
Thank you, Krishnan. Good evening, everyone, and a very warm welcome to all of you. Thank you for joining us today on the conference call to discuss our quarterly performance. We have with us Nisha Godrej, Executive Chairperson, Vivek Gambhir, Managing Director and CEO, V. Srinivasan, CFO and Company Secretary, and Samir Shah, Head Finance, India and SAARC and Investor Relations. Like all our previous quarters, we'll start with the presentation with Vivek sharing his thoughts on our performance, and then we can open up for Q&A. Over to you, Vivek.
Good afternoon. Thank you, Tapan. I am pleased to share with you the highlights of our performance. I also use this opportunity to get your feedback. Overall, as we reflect at fiscal year 17-18, our focused strategy and balanced portfolio enabled us to deliver competitive, profitable growth despite tough operating conditions in a few of our categories and geographies. Our constant currency sales for the year increased by 9% on a comparable basis. EBITDA increased by 12%, led by robust gross margin expansion. EPS growth was at 25%. The board has declared an interim dividend of rupees 7 per share. This, along with the earlier interim dividends, aggregates to rupees 10 per share dividend for the year. This results in a payout ratio of around 50%. Beyond the quarterly financial performance that we will discuss, we spent a lot of time last year in putting some significant building blocks across our operations. In Africa, it was about putting strong talent in place, creating a Dubai center, scaling up local manufacturing, and launching our wet hair portfolio. In Indonesia, it was about reinvigorating our innovation engine and laying the groundwork for a significant transformation of our go-to-market approach. In India, it was some very strong work in digital marketing, re-architecting our distribution, and strengthening our analytics capabilities. And across the board, there has been some tremendous work done in terms of our NPD pipeline. So while all of this work may not show up in one quarter's financials, these kinds of efforts, we believe, are making us more stronger and resilient and will enable us to step up our performance and trajectory. So we have really used the macroeconomic challenges over the last 12 months to learn and reinvigorate our approach to becoming much more agile. Now, turning towards the performance in the fourth quarter, if you take a look at page 3, this quarter we had a mixed performance with relatively softer sales growth while sustaining robust EBITDA growth. Our India business delivered a competitive 7% comparable growth, driven by volume growth of 6%. Our secondary sales growth was higher at 10%. For the year, India delivered a 10% comparable sales growth, driven by 8% volume growth. EBITDA for the year increased by 21%. As we mentioned before, the performance in our international business was relatively softer due to the weakness in Indonesia and Africa. However, we expect to see a strong turnaround in growth rates in fiscal year 2019. Many of the geographies that we operate in are projected to have stronger economic growth. So that should fuel stronger consumer demand. On slide 4, we lay out the exceptional items, and on page 5, we show the bridge between reported to operating EBITDA. If you take a look at our balance sheet items on page 6, our balance sheet keeps on getting stronger every year. Our net-to-debt equity ratio has come down to 0.41. Our return on equity, return on capital employed are all heading in the right direction. And in terms of our other metrics as well, such as working capital, our teams continue to make and show good progress. If you take a look at our India performance, as we mentioned, our India business delivered a sales growth of 7% on a comparable basis. This was based on a volume growth of 6%. The secondary sales growth of 10% was much higher than a primary growth, led by initiatives to increase our channel partners' ROI. And what is encouraging here is that, first of all, for the year, we have returned back to double-digit growth, and we've delivered strong profits while making competitive investments in our brands. And so, along with the 22% growth in EBITDA, our marketing investments also grew by 22%. So our gross margins have been increasing steadily. We are applying a lot of that back into increasing marketing spend, along with a certain amount flowing into to EBITDA. And this point is quite important, that consistently our profit growth is being delivered while investing in our brands. And we believe that these investments are strengthening our brands and are also setting up well to accelerate growth in the quarters ahead. We believe that in India, the platform is set well for us to get back to double-digit growth this year on the back of continued improvements in the economic environment, particularly stronger rural demand. And even in Q4, rural grew at a significantly higher pace than urban. And given the focus of the government on rural development and assuming a normal monsoon, we should see further improvements in rural growth. The other important thing to point out is that we have spent the last few months post-GST re-architecting our distribution approach. And so we have a much stronger go-to-market approach with expanding coverage, much more planning at the micro level, more effective use of technology, addressing coverage gaps, optimizing the ROI of our partners, and stronger shopper visibility. All these building blocks certainly provide us a stronger platform to deliver stronger growth this year. We are also very excited about our innovation calendar for this year. We have 10 launches that are being planned in India across categories, and we are targeting about at least a couple of launches in every quarter. Over the last month in itself, we have launched a couple of fairly exciting new products on the insecticide space. If we take a look at our category performance on slide 10, our household insecticides clearly had a subdued performance. Some of it was driven by an adverse season, particularly in January and February. However, what's encouraging is that our average growth rates are back to double digits for March and for April. Our recent launch in personal repellents is scaling up well with a double-digit market share. We launched Goodnight Power Chip. Goodnight Power Chip is a new electrical solution with a concentrated gel technology and at a lower price than liquid vaporizers. Through this, we are targeting to upgrade coil users with a better solution. We believe that the opportunity to upgrade coil users is significant. This will also enable us to recruit new users. The Power Chip is a very affordable product with a price per night at 2/3 of a coil. It's more effective and more efficacious than coils with a unique gel solution. It's quite convenient, which is a simple plug-in use. And particularly, given the government's efforts for rural electrification, this should give us, a tremendous growth boost. The other important point is that this is a registered design, which we believe will make it difficult for competitors to copy the product. And towards the end of the quarter, we also launched a higher efficacy liquid vaporizer under the Goodnight brand. On the soap side, on the hair color side on slide 11, the growth was 3%, but this was followed by 33% growth in the third quarter, driven by channel upstocking post-GST-led MRP cuts. So therefore, I think a more appropriate way to look at this growth would be over a 6-month period, where the growth stood at a healthy 18%. Godrej Expert Rich Creme continues to improve penetration and gain market share. And again, in this category also, we have a couple of fairly exciting launches planned later this year. On soaps, the double-digit growth momentum continues with a 19% growth. The growth was driven by very effective micro-marketing initiatives, right pricing our products, and strong on-the-ground execution. And both Godrej No. 1 and Synthol did well, and we've continued to gain market share during the quarter. The focus on our innovation agenda continues. I think last year, the pace of new launches has slowed down a little bit. But we've used the volatility of last year to take a step back and figure out how to reinvigorate our innovation pipeline. And our expectation is that this year will probably be the most active NPD launch calendar ever in our history. So we are very excited about the kind of disruptive products that we are creating at different price points. In terms of air fresheners, we've continued to maintain a leadership position in the overall market and gain share. If you turn to international, clearly the performance in international business was softer due to the weakness in Indonesia and Africa, but certainly we are expecting a strong turnaround in growth rates this year. To spend a couple of minutes on our Indonesia business, and that's on page 19, the macro environment continues to be challenging. The good news is that we sustained our robust margin expansion. Our EBITDA margin increased by 370 basis points, despite a 160 basis points increase in A&P. So we've definitely been investing in our brands and at the same time finding ways to improve gross margin and manage our cost to deliver strong margins. Earlier on in the year, as we had mentioned, we had lost share in HI, our main category there. The good news is that we've regained back all the lost share. The growth in this quarter was unfortunately impacted due to some of the modern retail partners reducing their inventory. But the sellout rates, have been much better, and the fact that the share gains are now showing up gives us enough confidence that the worst is probably over, and you should start seeing recovery happen in the quarters ahead. We have been getting much more strategic in our promotion spending, guided by a strong playbook that we put into place. Our expert platform under HI has been launched to create a new platform for head. That's been doing quite well. We have done a brand restage on our Stella air freshener brand, and we are backing these new products at scale media investment. There's a lot of great work happening in terms of both innovation and the transformation of our go-to-market approach, and we should start seeing the impact of this from Q1 onwards. On our Africa, US and the Middle East business on page 20, this was a relatively weak quarter with constant currency sales growth of 7% in the quarter, led entirely by volume. For the year as a whole, sales grew by 14% on a constant currency basis. The sales were impacted by a continued sluggishness in Kenya. The business excluding Kenya grew in double digits in constant currency terms. The margins were impacted due to some upfront investments we are making in talent, in brand building, and factory infrastructure to strengthen the foundations of the business. The scale-up of a wet hair portfolio is seeing good traction. I think it has fallen behind a little bit, but we are now regaining back momentum in terms of local manufacturing scale-up. We've launched a naturals range under African Pride in the US, and we will bring that to Africa, the naturals range, at some point soon. We are planning for a very exciting relaunch of the Darling brand this year, and there is significant investment going on in go-to-market along with salon engagement. There's a robust pipeline of NPDs that have been put into place. We've set up test centers and consumer insighting capabilities in each subcluster in Africa. We've also launched a very exciting online presence called the Black Hair Hub to drive consumer engagement and advocacy. The marketing talent has been ramped up across subclusters. So we believe that given all the building blocks that we are putting in place, the performance should be much better this year and going ahead. We remain very excited by the potential in Africa. On Latin America, we saw a recovery in performance with a 28% constant currency growth, and in Europe as well. While the profits were a little bit on the lower side this quarter, for the year as a whole, the European business has done very well. The remainder of the slides just provide a summary of our financial performance. We'll be now happy to take your questions. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. If anyone wishes to ask a question, may please press star and 1 on your touchtone telephone. If If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Sinha from Macquarie. Please go ahead.
Yeah, thanks for the opportunity, sir. My first question is on your HI business. So what is giving you the confidence, apart from a good April month, on the revival of the segment? Is it the industry growth coming back, or your new launches have done exceedingly well?
I think ultimately what gives us the first level of confidence is that, see, in any case, given the fact that we are over 50% of the market, to a large degree, I think category growth rates are driven by both the kind of actions that we take along with, I think, the environment. I think January, February, just given the season, mosquito infestation was on the lower side, and we can't do too much about that. But having said that, I think what's in our control is to keep on finding ways through strong marketing and a very active NPD pipeline to keep on expanding the category. I think what's giving us confidence is that we're now seeing the personal repellents business gain a certain scale, and along with that, we have at least 2 more launches that are in the market. There are 3 or 4 others that are in the pipeline for the remainder of this year. So as we do our initial consumer testing, as we look at the propositions and the kind of NPD calendar that we have, I think the level of confidence again is high that for the things that are in our control, I think we should be able to execute much better. Having said that, this is a seasonal category, so there could be some quarterly volatility. But suffice it to say that, we've learned a lot from the last 12 months in terms of the kind of innovations that we can bring to the market.
Sure, sir. My question was basically earlier also before FY16 we used to see quarterly volatility, but on the entire annual basis the numbers used to be much higher than what we have seen in the last 2 years.
Yeah.
My question is that you have given a broad indication of a double-digit kind of a number next year. Do you share the same confidence for this segment, or this segment will be lower than the rest of the India volume numbers?
It's difficult to say here because the last couple of years, given demonetization, given GST, given some drought conditions and unfavorable seasons, there are far too many factors to be able to actually diagnose why category growth, went down. From a market share perspective, I think, we've been holding steady. But, clearly, I think if we look at our NPD launches over the last 2 years, apart from personal repellents, which is still in its early days, we haven't had any significant launches over the last 2 years. And if you were to look at our performance 3 or 4 or 5 years ago, a lot of, I think, our success was driven by some very strong launches. And this is a category where sometimes you need 2 or 3 years to get the launch, the launch calendar right, given registrations, etc. So I think a lot of the work that we've been doing over the last 2 years will now hopefully start showing a lot more fruition. So I think our hope is that you will see category growth rates improve, but as I mentioned, a lot of what we end up doing will influence category growth rates more than anything else.
Okay, sir. My second question is, while your communication on the new product Power Chip is very clear, and the strategy is to recruit from the coil users, but when I look at your TV commercial, it seems to target again the urban consumers. Now, my question is that in that case, will this new product cannibalize a significant part of the liquid product sales? And if that happens, then what happens to the margin profile of the segment?
So I think the advertising, I don't know what you mean by targets an urban consumer. I think most ads, if you look at it, even in Fast Card, which is clearly a rural product, I think the way the films are made is to make them sort of aspirational. That being said, to release a product like this, we do quantitatively very significant research. And what we found in that research was that this was a very attractive product to coil users, both because of the differentiation, price point. We're seeing much more electrification in India than the past. So it was definitely both at the concept and the product level very high. For LV users, which has its own benefits, they did not react to this product in the same way. So obviously we took into account what would cannibalization be. Can I say that hand over heart that it will be 0% cannibalization? Probably not, but we didn't think it was. And in India, if you look in any category, detergents, other products, there's always a price ladder and people pay for the value. Also, please do note that one of the other things that we have launched is an LV, which has double the sort of power that our current LV does, and we've not put that in as a higher price new product. We've just launched it literally as a replacement. So we are also at the same time giving LV users a much more efficacious, powerful product. And there are other. I don't know how. I'll just make one comment, but say in LV, something like your power boost, where you can put the speed of the LV up and, get a much, much higher release, is not an option you have in something like the gel chip. So there is significant delta in terms of product value delivered for the price we demand for that. I hope that helps to answer the question.
Yeah, that's very helpful. Thanks a lot.
Thank you. The next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, sir. This is Percy here. Sir, in this quarter's accounts, there is a exceptional gain of 194 crores. Could you explain what that is regarding to?
Percy, hi. This is Sameer here. So this basically is a refresh of profits for our Strength of Nature US-based business. So in FY17, we had certain profit estimates which were quite aggressive, and this was done consciously to ensure enough skin in the game for the erstwhile promoters who are, kind of operationally driving this business alongside us. So we have kind of revisited this profit estimate since it's more than 2 years, of the business. And that has resulted in the overall financial liability, which was booked in FY17, coming down in balance sheet, and the corresponding impact of it flowing into the P&L, which is shown as exceptional income of around 195 crores. And the refreshed, profits or the revised, profits are also quite healthy. I would say, while it's difficult to, carve out only for Strength of Nature's business in US, but they are still in, close to like, high teens or inching towards 20% in terms of margins profile.
Right. So, in FY17, just refresh my memory, what is the provision which you had booked in the balance sheet? Was it around 800 crores?
It was close to around 1,000 crores per se.
1,000 crores. So 1/5 of that is getting shaved off. So would it be fair to say that the profit estimates are also shaved off by 1/5?
In absolute terms, yes. From the estimates at that point in time.
Understood. See, secondly, Indonesia, and just correct me if I'm wrong on this, but I recall that in Q4 last year also you had said that there was a modern trade downstocking. Is that correct?
Partially, yes.
Okay, so there has been a further downstocking on a low base also.
Yes. What is happening, in Indonesia, if you track some of the other, listed HPC players, performances, as well as some of the retailers who are listed, is to improve their own working capital. We are seeing huge pressure actually on a lot of this, modern retailers to reduce down their stock levels. And that is what we are seeing, at least in our business, over last, kind of 3 to 4 months. So if I had to kind of quantify this works out to just for the quarter a growth impact of around 7 to 8%, which would be 2% on a full year basis. So yeah, I mean, that's what we have seen right now. I mean, with some of this mini-mart, kind of retailers in Indonesia. And I think it's quite widespread as what we understand. We also hear from a lot of other listed, large players.
Okay. So 2% on a full year basis, even if I adjust it, there would still be a decline in Indonesia for the full year FY18, right? And given that you have increased market shares and yet seen a decline in sales adjusted for inventory levels, that would mean that the industry size itself has materially shrink, maybe by around almost 10% kind of shrinkage in the industry size. Is that understanding correct?
So I think a couple of points over here, Percy. One, I think if you look at household insecticide category growth in Indonesia, it has been in negative zone since last 3 quarters. In Q1 of FY18, this was in positive zone, but in last 3 quarters, the growth has been negative. Also, what Vivek shared initially, that, the sell-in, sell-outs are, happening at healthy pace. So this is more of, a lead indicator that recovery in, market share will result in a better primary sales growth, for us in the coming quarters. So that's the way to read this, share gain correlating to the primary, sales which will have in the coming quarters to modern retail, partners.
No, I understand the general principle. I'm just saying that the numbers are too starkly negative. I mean, there seems to be a disconnect between syndicate Nielsen data and what is the derived market growth looking at your market share and your sales growth. So just to sort of elaborate, I mean, you have about 40-50% of sales from HI and the remaining is other products, and those are actually growing, right? So they are growing by maybe around 10%. So if you derive your HI sales for FY18 and even adjusting for modern trade, destocking, etc., your HI sales might be double-digit negative and you have still grown market share. So, I mean, I'm just saying that there seems to be a disconnect either in the Nielsen data or in the fact that you've sort of grown market shares.
I think, again, couple of things, and we can take this offline. One is also the sales which gets reported, I mean, not just for Indonesia, but across our businesses after, the sales promotion spend. So that could be one disconnect in what Nielsen is tracking, which is the retail price versus, what you report in sales. So honestly, there is no direct, correlation, I mean, to some extent, between both, absolute numbers. But directionally, yes, I mean, we have degrown, in household insecticide category, say in FY18 in Indonesia in double digits. And as I mentioned earlier, share gain, I mean, what has also happened is this is exit, market share. So this is comparing March 18 market share with, say, March 17, the first 6-7 months where we lost the share, and last, kind of 5-6 months where, we have kind of regained back most of the lost market share. So yeah, I mean, that's how, we would want you all to read, both the market share recovery as well as the overall sales growth of the past and perhaps in future also.
Understood. And last question, if I might, you said that this year you have huge amount of launches lined up. So just wanted some kind of understanding. Generally, I mean, in the past you have been saying that this year profits will grow ahead of sales or in line with sales, etc. So would you say that there is a possibility that for FY19 your operating profit might grow slower than your top line?
So, Percy, you're very right that, this year FY19 across board we are going to see very strong, innovation-led growth, at least in some of the large clusters in which we, operate in. But having said that, again, at this point in time, we remain very optimistic of having profitable growth, and the way we would define profitable growth is expanding margins. The, vectors, whether it be, favorable mix, cost-saving programs, even media spend optimization, and we'll talk about a little bit more over the next, few days on this. The drivers are in place, which gives us a lot of comfort to reinvest back for growth as well as to expand, this historic high margins which you have had in FY18.
Great. That's all from me. Thanks and all the best.
Thanks.
Thank you. The next question is from the line of Manoj Menon from Deutsche Bank. Please go ahead.
Hi, team. Just a couple of questions on margins before I jump into a couple of others. The first, the short term, could you help us understand the margin bridge for the quarter? The question is that, you have 29% EBITDA margins despite a lower contribution from the higher margin insecticides in India and a 20% growth in soaps.
Sure. So I think you're referring to the India margins, Manoj.
Yes.
Yeah. So I think again some of the drivers has been largely, gross margins, but within gross margins it has been lower, cover which we have on palm oil. We also have kind of activated and fast-track strategic sourcing, and strategic sourcing would be for some of the key ingredients like, say, actives, which is, the molecules in household insecticides, or even good covers on, perfume. So I think cost-saving programs, lower cover on, palm oil, has kind of resulted in this, meaningful gross margin expansion. Again, part of which has got reinvested back for growth, and part of it is, kind of flowing to bottom line.
Understood. And, is that something which can repeat, into FY19 in terms of covers, etc.?
So I think at this stage, at least for next couple of quarters, we remain very optimistic of this gross margin, trajectory.
Okay. Understood. And just a philosophical thought. The India margins at high 20s, it's actually even better than what Hindustan Lever reports on, the personal care category. And what I understand, for example, someone like a Reckitt is like a 30% margin company. So how do we think about margins into the medium term? One, the sustainability of it. Point number two, do you actually want to, want it to be here because it will end up attracting more competition just because of the profit pool?
Well, Manoj, I wouldn't read too much into one quarter's margins. I think if I look at the entire year, our margins have been around 25%. Clearly for us, the formula has to be higher gross margin expansion. Some of it will come from revenue growth management, some of it will come from better sourcing, more manufacturing, and some premiumization. But ultimately, I think we are comfortable with the level of India margins. Our focus is far more on aggregate GCP and consolidated margins, and we still believe that there is room in Latin America and Africa to drive up margins. So rather than us focusing only on India margins, I think our effort will be to look at consolidated margins and try and ensure that they remain ahead of sales growth. Having said that, again, if we need to invest in brand building and new innovations, that will be the single most important priority. But our belief, though, is that there is still enough opportunity to be able to drive consolidated margins.
Okay, understood. Just on the Indonesia part, couple of questions here. One, sorry if I didn't hear earlier, appropriately. Is there anything other than the narrative of the election year, etc., which is seen as something which should rejuvenate the consumption there? Any bottom-up activities, if any, in the pipeline you could talk about? And point number two, looking back, if you could help us understand the drivers of the market share gains.
On the macro front, honestly, I think things are still looking more of the same. So we're not seeing any significant green shoots for a recovery. Having said that, though, Indonesia does tend to be fairly commodity dependent. And if commodity prices globally go up, Indonesia should start seeing some benefit. And as you mentioned, typically with provincial elections this year and national elections next year, there should be some, boost in the economy, which should lead to a better consumer spend. We'll have to, wait and watch. But apart from that, we're not seeing any significant uptick in the economy. On the market share, gains, a lot of it was driven by some of the innovations that we've launched. One of the main innovations that we've launched has been the hit expert range of more premium insecticides. That has done quite well. And given the kind of momentum we are seeing with that, there are some more products that are being planned later on this year to build a more expert platform kind of a range. But that was one of the key reasons that led to the market share gains that we saw in the insecticides category there.
Understood. And thank you. And I'll come back in the queue. Thank you.
Thanks, Manoj.
Thank you. The next question is from the line of Aditya Gupta from Goldman Sachs. Please go ahead.
Hi, good evening. A couple of questions. First, on soaps, so you mentioned market share gains, and this has happened for the last 2-3 quarters now. Any color if this is mostly coming in from the unorganized players, or are you getting market share from other formal players also?
It's a combination of both. See, from the Nielsen data that we see, I think we are seeing, some players who are losing share. So some share gains are coming from existing players. What's not fully quantifiable in the Nielsen data is actually because our growth rates are much higher than what Nielsen would report. And that delta, I think, is also being driven by, I think, some of the challenges that some of the smaller players are facing in this category in certain geographies. This is more anecdotal, but our hypothesis is that a certain amount of share gain is coming for us and some other players as well, from a shift towards slightly larger organized players as well.
Right, thanks. Second is on the other brands. Now, this is fairly big. So can you give some more granularity on which brands are the top 3-4 brands which are getting clubbed over here and how have they been growing?
Yeah, so largely this would be categories like air freshener where we have air brand, this would be liquid detergents where we have Easy and Genteel, as our lead brands. And then there would be toiletries wherein we would have, Synthol, Deo Stick, Synthol deodorant. So that's, and Protect, range of, hand wash and hand sanitizer.
Okay, all right. Those are the questions. Thank you.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and want to ask a question. The next question is from the line of Anubhav Sahu from MC Research. Please go ahead.
Hello.
Yeah, hi.
Hello. Yes, sir. So once again, a question on Indonesia. We understand what you're saying on the macro front as well as market share gain thing. So on the margin profile thing, do you see that the 26-27% kind of margin profile can be seen for the near term, for the fiscal year, for the current fiscal? How do you see that?
So, Anubhav, I think our efforts initially would be to, get the growth, back on track. I mean, we have had, honestly, internally disappointing year in terms of Indonesia's, sales performance, and we would want to invest in go-to-market, most of the general trade as well as new product launches to get the growth, back on track. I think if we get the growth to a respectable level, then we'll have the scale, kind of leverage, and hopefully we'll be able to maintain, margins. But I think the entire focus in this fiscal year for Indonesia is going to, be on, driving sales growth, to begin with.
Okay. And sir, can you also provide some guidance on the raw material cost? How are we placed right now? How is the palm oil price and other things going on? And are we willing to go for a price hike? Because largely we have seen a volume-led growth this quarter. Yeah.
So as I mentioned earlier, we do have low-cost, palm oil covers at least for, next 2 quarters. I think the impact of crude is an indirect one. We don't directly import crude. I mean, there are materials, most of the packaging ones, which has adverse impact of crude, but normally it's a lag of 6 months. So we honestly have 6 months of time to react to any price changes. But at least the next couple of quarters, I think we are, quite, kind of protected against any increase in input cost. And for the period beyond that, we will evaluate calibrated price increases or maybe some other cost-saving initiatives to, continue, profitable growth, momentum.
Right, sir. And so, regarding this pass-on of a price cut as per GST thing is concerned, so that process is done in our side? I mean,
yeah, it is done. I mean, we did pass on the benefits of GST rate cuts in the first round in soaps, and then mid-November we did pass on the benefits in hair colors, air fresheners, toiletries, as well as liquid detergents. And that's the reason why over last 3 to 4 quarters in our India business, you are seeing a relatively higher volume growth and a lower value growth because of the price-led, degrowth, which is nothing but the GST cut, benefits, which have got passed on to the consumers in form of lower, maximum retail price.
Okay, that's great, sir. That's great. And so one more strategy question regarding the B blend, how it is now integrated into the system, how do we position it right now?
I think B blend for us is a very exciting Horizon 2 brand. We are still experimenting, testing and learning in terms of, some of the propositions that we are creating. And a lot of the business is now being pivoted to become a more digital-only brand. So still very early days, but in terms of the kind of plans that we had for BBlunt, it is on plan and we're very excited. But I don't think it will be a meaningful contributor to revenues for the next 2 or 3 years. But there's a huge amount of learnings that we are getting. It's also feeding into the rest of the portfolio. So it's on track, but I think it's more of a Horizon 2 as opposed to a current Horizon growth opportunity.
Okay, sir. That's very helpful. Thanks a lot for taking my questions.
Thank you.
Thank you. We take the next question from the line of Samir Gupta from India Infoline. Please go ahead.
Hi, sir. Percy here again. Sir, on soaps, just really wanted to understand the story because it's a hyper-competitive activity, category, and it always has been like that. And in the past, sometimes we have seen when the growth for 2 or 3 quarters is very high, then next 2 or 3 quarters, sort of it averages out. So just wanted some kind of reassurance that this growth rate, I know it will not stay at this level, but for any reason whatsoever, do you envisage that the next 2-3 quarters could actually be below average and then over a longer period of time this actually averages out?
We're not seeing any significant concerns to the point where growth would significantly slide down. Having said that, this is a mature category, and so we do know that the actual category rates tend to be on the lower side. Clearly, some of the work that we've done on pricing, revenue growth management, marketing activations, micro-planning, strong marketing at a state level seems to be working quite well for us because, we are gaining a certain amount of share. From our planning point of view, this is a low double-digit growth category, and so as we look at our plans for the next 12 to 24 months, we are not counting on this kind of growth to be sustained. If it happens, that's fantastic. We'll continue trying for it, but from a planning point of view, this is a low double-digit growth category.
Understood, sir. And if I could just go into a little more detail here, a couple of sub-questions. One is, you did mention a sort of several things that you are doing, but what exactly is driving this market share gain? Or if I have to put it the other way, if I am your competitor, then what am I doing wrong or what am I missing out? Because as a competitor, I don't want to lose market share. What do I need to really do which sort of can stem this market share loss? And secondly,
answer that we'll be telling our competitors what we think we should do. So I think you'll have to excuse us from that question.
And again, look, it's not a one-quarter story, right? If you look at our sales performance, I think over the last 4 or 5 quarters, it's been a sustained level of growth. While clearly there is GST and demonetization and all the kinds of things, I don't want us to be able to sit in somebody else's shoes too.
Sure. Or if I just phrase it other way, do you think the main reason is because the relative pricing has changed or is it something else?
No, I think it's less about pricing here. Honestly, it's far more about execution, and sometimes for some companies, some marketing tends to work better than others. In the past, when things haven't worked for us, maybe our marketing hasn't worked quite well or we haven't executed quite well. I don't think there's any secret formula here beyond just, I think, good marketing and good execution and good focus. A lot of things have come together and we feel confident that we'll keep on sustaining it. Having said that, though, as you clearly mentioned, I don't think we can count on this level of performance to be sustained. So we have to create enough other growth vectors as well because this is a more penetrated category.
And is this market share growth coming from a few states or is it across the country?
No, it's a few states because, our focus has been on a few states, and the states that we are focused on, that's where we're seeing these advantages.
Okay. Are you at liberty to name them?
No, I'd prefer not to.
Okay. And sir, second question on household insecticides. If I look at your growth on an average over the last 8 quarters in household insecticides, it's around 2%. And if I look at your soaps or hair colors, it's about 7 to 8%.
Yeah.
And traditionally, I mean, if I dial back, traditionally we've seen household insecticides as a fast-growing industry, and within that we're gaining market share. So we have actually grown even faster. Now it seems that the industry growth itself has sort of come down, and the market shares, if at all are happening at a much slower pace. So what's the future of HI? I know the broad story, under penetration and all that things over a long period of time, those definitely play out. But over a 2 to 3 year view, why do you think household insecticides in the next 2 years will behave differently from the last 2 years, for example?
Yeah, I think, if you were to dissect the HI opportunity, right, there is clearly an opportunity which is far more penetration-driven. There's an opportunity which is consumption-driven. The consumption opportunity tends to play a little bit more on the urban side of things. And given the economic volatility, with demonetization and the economic environment, and the nature of the category, with a certain amount of seasonality, consumption has always been a bit of a challenge over the last 2 quarters. We've tried to address the consumption issue by some newer products like personal repellents. Still early days, but the potential to drive consumption through things like personal repellents, that story I think will play out in a stronger fashion as that category or the format gains traction. The challenge we've had over the last 2 years has been that penetration has slowed down, and we have not been successful in terms of attracting new users to the category. But 4 or 5 years ago, we saw a tremendous opportunity with Fast Card driving rural penetration. So just to give you a context, about 5 or 6 years ago, penetration for rural was stuck at about 30% or so. That penetration level went up by a meaningful number once Fast Card was introduced. The Fast Card has been a very strong top-up format, but because of the duration and longevity of the Fast Card proposition, there's only a certain amount to which Fast Card could drive penetration. And strategically, I think we had taken a call to deprioritize coils, because it's more of a commodity and a lower margin category. But we never really had a substitute. And coils in the past have been a fairly good recruitment driver for people into the category. But because over the last couple of years, as the market leader, we did not have an effective substitute for an upgrade solution or a recruitment solution for new users, I think across the board, penetration of new users in this category has been plateauing. And that is what has driven some of the challenges in the category, along with, a certain amount that comes through seasons. And the combination of those is what really led to the kind of situation we've experienced over the last 8 quarters, as you mentioned, where our growths have been good. And this is where Power Chip comes in, because our belief is that with Power Chip now, as Nisa was mentioning, we have a product that is 2/3 the price of coil. It is affordable. It is extremely efficacious. It's easy to use. And now, given some of the efforts that are happening with rural electrification, we believe that the next recruitment vehicle and the next vehicle to upgrade coil users will be Power Chips. If that plays out, along with some other formats and products that we're creating, that's giving us the confidence that while the last 2 years has not been good for HI, at least the growth vectors that we are putting in place, if we execute them well, should allow us to get growth back in a positive territory, regardless of seasonal impacts. While seasons will have an impact, I think if we can create these growth vectors across various formats, it will allow us to drive penetration back to where it should be.
Thanks, Vivek, for this very detailed answer. On Power Chip, yes.
Percy, may we request that you return to the question queue? There are participants.
Absolutely.
You can take it offline, Percy, yeah?
Sure, absolutely.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, please limit your questions to 2 per participant only. The next question is from the line of Rishabh Bhatla from ACK Capital Management Private Limited. Please go ahead.
Hi, so thank you for the opportunity. So my question is regarding the debt to equity ratio. So we have seen the debt has declined around 12.6%, which is a good thing. So do we expect the same thing happening over this year as well?
Hi, this is Samir here. So actually what you've seen is as of March 2018, our net debt to equity has been 0.41, and this used to be around, say, 0.067, 0.068 as of March of 2017. The answer to your question is also in turn dependent on, whether we are going to have any inorganic growth in FY19 or not. Because at this point in time, if you assume a scenario that, we are not going to have any inorganic growth in FY19 and read with the fact that, we are in those categories which are not very capital intensive, my sense is, with the free cash flows which will get, kind of generated in the business, our net debt equity should come down further from this 0.41 level during the course of FY19 also.
Okay. Fine. So next thing is regarding the rural-urban sales breakup. Can you give me the exact figures? What amount is rural and what amount is urban?
Yeah. So I think in terms of saliency to begin with, rural is close to 30% of our general trade sales in India and 70% is urban. General trade itself is 90% and then modern trade largely plus institutional CSD would be 10-11% sales. If we decompose the overall sales growth, around 2 to 3% of the growth has come from urban. Rural has been 7 to 8% growth for us in Q4 of FY18.
And for the year, just mentioned 1.2, 1.3?
Yeah.
For the year, I think rural growth is about 1.2 to 1.3x of urban growth.
Okay, fine. That helps. Thank you so much.
Thank you.
Thank you. The next question is from the line of Amit Kumar from Investec Capital. Please go ahead.
Yeah, thank you so much for the opportunity. So just one question in mind. On the palm oil side, there has been this increase in duty which has come through, I think, in March. So about a 14% increase both on the crude palm oil side and refined palm oil side. So 2 parts to the question. One is that does this sort of drive you to look at domestic sourcing, and if not, then what kind of impact would it have? So these covers that you have, who sort of bears the increased duty? Is it the supplier, or do you have to sort of bear it?
I think to begin with, the change is on not on not on the crude palm oil, it's more on the refined, palm oil. So that's one change. In parallel, what we always do, not just driven by, kind of duty rate changes, but generally also is evaluate, buying locally versus, importing. So wherever we see, cost benefit, we kind of press the lever in terms of making our buy decisions.
Okay, and in terms of the covers that you, sort of take, the duty on that essentially, that is your liability, or, that sort of becomes the supplier liability?
No, that's our liability only, but as I mentioned, the change in duty is actually on, crude palm oil. So to that extent, there is no impact as such, on any of the, kind of palm oil, kind of consuming, companies in India.
All right, understood. Thank you. That's it from my end.
Thank you. The next question is on the line of Binoy Zariwala from Sunidhi Securities. Please go ahead.
Thank you for the opportunity. My question is on the Indonesian business. So I just wanted to understand what kind of headroom do we have to grow in the HI category in Indonesia. I believe we've got a presence in about 50% of the overall HI market. So are we looking at entering the remaining 50%?
Certainly, I think the remaining 50% of the opportunity, the white space that we're looking at. I don't think we will enter the coil category, but certainly there are opportunities to upgrade coil users like the way we are doing in India.
Yeah, so I think if you look at things like power chips and stuff again, are options that we have there. So we definitely will enter that market to solve the consumer need, but we won't do coils.
So that means which is essentially personal repellents only, right?
No, it's not personal repellents. There's a big market for coils and there's a big market. The personal repellent market there is much, much bigger than in India. And consumer use also is very different than it is in India.
Right. Second is on the hair care, which is in overall about $200 million category in Indonesia, and we've in FY17 we entered hair color, which is a sub-segment of the overall category. So again, my question is, over a period of 2 to 3 years, do we look ourselves as playing in each of the areas? How should I go about thinking on this?
So I think the new brand, we started with hair colors. We do have other products in the pipeline, but our first sort of focus is on hair colors and, building our market share and success there. So, and, the brand has been doing quite well. It's been very well received. So we do have other products in the pipeline, but our first goal is to get a significant market share in hair colors before we start investing in any other product.
And distribution presence-wise, is it placed in the entire of our distribution universe, which is about 200, is it available across 250, 300,000 outlets in Indonesia?
Our reach is about over 500,000 and our direct coverage is about in the low 100,000. But I think clearly over the next 3 years or so, our intent would be to double our direct reach as well. And some of these products like hair color, some of the lower price points that we have in insecticides, baby tissues, etc., the bouquet of products is there for us to now start driving general trade much more aggressively. And that's a big growth opportunity for us over the next 3 years in Indonesia, because we are significantly overweight on the modern trade part of the market.
Sorry, I couldn't get the overall reach number. You said direct reach is low 100,000 outlets?
It's about 120,000 is our direct reach.
Okay.
And our products are available in about 520,000 outlets.
Sorry, 310 is it?
500 plus.
500 plus, okay. On the Project Pi, if you could help me with what kind of savings have we cultivated in FY18 for India and Indonesia, because I think these were the two main geographies where it is running, right?
Yeah. So I think in India we estimate that Project Pi would have contributed anywhere between 150 to 200 basis points to gross margin expansion. In Indonesia, this project scaled up during the second half of fiscal year. Also in the first half, it didn't have the scale to kind of leverage upon. So I think the big impact of Project Pi in Indonesia will be seen in FY19. In fact, that's going to be one of the big, kind of growth, pillar to kind of support the go-to-market initiatives, new product launches, and also perhaps, maintain, expand this historic high margin.
And what kind of savings do we... Yeah, I'm just...
May we request that you return to the question queue? There are participants waiting for their turn.
Yeah, I'm just completing this question.
So there are participants waiting for their turn. May I request that you return to the question queue?
Sure.
Thank you so much. The next question is from the line of Kunal Vora from BNP Paribas Mutual Fund. Please go ahead.
Thanks for the opportunity. First question, how does crude price impact your business? The key impacts, maybe raw material price, pickup in commodity-driven international markets, need to take price increases. Can you share your thoughts on how crude price, if it remains elevated, will impact your business in the next few quarters? And second is with... if you can answer the first one, I'll go to the second.
Hi, Samir. So crude definitely does have impact, across the board. Whether it be India business, Africa cluster, or even Indonesia business. In India business, the impact is relatively lower. That's because, close to say 40% on an average, of our cost basket is palm oil and rest is, non-palm, of which crude would be a meaningful, kind of component. In Indonesia business as well as in Africa business, we do see impact of, crude prices. But as I mentioned earlier, right now we have, couple of quarters of, comfort, either through, kind of locked in, volumes or prices with our, suppliers. And once we kind of see the impact, the gradual impact to begin with of, higher crude in terms of, affecting our gross margins, we will either work more hard in terms of cost saving initiatives or even evaluate, gradual select, price increases at that point in time. So to be honest, at this stage, we are not too worried, of crude being at 70 or, 70 plus at this point in time, because we do have the comfort of continuing this, gross margin, kind of momentum at least for next, couple of quarters. And in this period, we will kind of plan out as to what will be our action, if any, starting, say, kind of mid FY19 across our clusters.
And do you see some benefits of higher crude price, maybe in some markets which are commodity driven? Do you think the macro situation in those markets could improve?
Yeah, in markets like, Nigeria, for instance, certainly there is expectation of stronger economic growth that could be driven by higher crude prices. In some geographies, yeah, we do see some economic growth benefits.
Sure. And what should we expect for pricing? Like you mentioned 10-12% volume growth, and there are some margin headwinds, maybe some impact on RM price. There is likely increase in advertisement spend. So would you take some price increases this year?
Our focus is honestly on trying to drive volume growth. And I think we will take a call. A little bit of pricing depends on the competitive environment and how the overall economic environment is shaping up. And so typically, our first, whenever input costs go up, our first bias always is to try and reduce costs, to try and see if we can make up for the increase. And if we can't do it, then we try and find ways to increase price. There's some pricing increases that will happen through premiumization and new product innovations, but then consumers are willing to pay for that. But our model is focused far more on driving volume growth. Given the penetration rates that we have in emerging markets, I think the volume growth focus is more important. Through revenue growth management, new innovations, if we can get some pricing growth, that's nice. And historically, if you look at the last 10 years of our performance, it's largely been in India about a 70%, 75% volume growth story and a 25% price-led growth story. That can happen over time, but I think our focus will be far more on driving volume growth.
Sure, understood. Thank you.
Thank you. The next question is on the line of Aditya Seth from Investec Capital. Please go ahead.
Hi, good evening, team. Thanks for taking my questions. First, in other brands, which category out of air, pocket, protect, etc., would be the biggest revenue contributor for us? And second question, sorry.
Air freshness would be the biggest category in others.
Okay. And my second question would be on our, can you share some, the hand wash market size and our share in that category? Anything in the hand wash market?
We don't talk about market shares.
Oh, okay, fine. So, in other brands, air would be the first one, and what would be the second one?
Liquid detergent. Easy would be the second one, liquid detergent.
Okay, fine. All right. Thank you very much.
Thank you.
Thank you. The next question is on the line of Prakash Kapadia from Anived Portfolio Managers. Please go ahead.
Yeah, thanks for taking my question. Most of the questions are answered. Could you give us some sense on feedback from channel partners in terms of, adaptation to new ways of doing business, billing across the chain, wholesaler, retailer, stockist, and what are we doing to ensure, to avoid disruptions, if any, at our end? And secondly, on bit of ad and sales promotion, what kind of a percentage you have in mind? Typically, what works given, the state of launches which we are, having in this particular financial year? Will be more sales promotion, will be more ad spend, if you could give us something.
See, in terms of the first question, if you look at our secondary versus primary growth, our secondary growth was 10%, our primary growth was 7%. So this delta in some ways has been is driving the optimization we're doing to ensure that our channel partners are getting the right kind of an return on investment, and we are very committed to ensuring a win-win partnership with the channel partners are concerned. On your second question with regards to the mix of ATL and BTL, I think that's quite dynamic and it varies by category. The primary focus does tend to be a lot more on ATL-driven strategies, but to the extent that, we need promotional expenses, we do that. The ratio typically tends to be 60%, 65% ATL-led, 30-35% is BTL-led, though that number can vary by, a category like coils, for instance, it would be a higher BTL. But roughly, rule of thumb that we use is somewhere around 60-40 between ATL and BTL.
Understood. Thank you.
Thank you.
Thank you. The next question is from the line of Bhavesh Shah from CLSA. Please go ahead.
Yeah, hi, good evening, everyone. So my question is on Africa region. If I recall, our margins used to trend somewhere around 15-16% during FY16-17, and today they are down somewhere close to 13%. And this is after adding zone portfolio, which are at relatively higher margins of 18 to 20%. So my question is that what has really happened to Darling portfolio margins over the last couple of years, and how do you see this trending going forward?
The good news is it will trend upwards, right? Clearly, margins are below our expectations, and there are a few reasons for it. One is obviously, if you see even the growth rates from 114 constant currency growth rate reported is around 108 for the year. So the implication of this is that some of the raw materials that we end up buying tend to be dollar denominated, and we've taken a conscious call to not pass on all these costs to consumers in the form of price increases, and that's led to a certain deterioration as far as margins is concerned. The second is, we've taken a strategic call to add a lot more talent ahead of the market. Some of this talent is coming in the form of a new center that we have in Dubai. We've also supplemented the talent on the ground as far as marketing is concerned. In some operations like Strength of Nature, we have upgraded IT systems like SAP, which are the right calls to do, warehouse management systems, etc., upfront expenditures being imposed there. And then fourth of all, I think we've significantly, on a very low base, increased our marketing spend, particularly for our wet hair launch. All of these costs, I think, are very front-loaded. Having said that, I think the team is embarking on projects to drive more operational efficiency. The scale-up of wet hair was probably slower than what we were expecting. It took us some time to get the local manufacturing right. Now we are feeling far more comfortable, which is why you've seen some of the margin improvements getting a little bit delayed. Assuming that currencies remain stable or if they can work in the right direction, that's one. And as the wet hair scales up, and as we start seeing better scale leverage from the overheads that we've invested, I think next year ought to be a much better year. It may take some quarters still, I think, but overall, I think for the whole year, we feel very confident that you will see, a significant margin improvement from our Africa business.
Sure, sir. Understood. And so my second question is on gap between constant currency and reported growth numbers. Do you see this gap shrinking going forward as the base also is getting supportive and even the way, Indian currency is moving? So do you expect this gap to, narrow a bit, assuming exchange rates remain where they are today?
Yeah, so Bhavesh, hi, Samir here. So it looks like, if you look at the translation effect over last, couple of months, it has been actually, in positive zone for Africa cluster. So that in a way should result in hardly any, meaningful or material impact at the overall consolidated, level. But to be honest, it's very difficult to call out, which direction the currencies will move. Say for rest of the year, but at least over the last couple of months, the trend is reversing. So that's
Bhavesh, the other thing is that rupee also appreciated last year. You see, from around 67, it came up to 64. Now it is returning back to normal 66, 67 levels. So I think that also will help in moderating the translation impact.
See, but honestly, I think, given, what happens, what US decides to do in terms of some of its trade situation, Indonesia, South Africa, Nigeria, India are all going to go through an election phase over the next 12 to 18 months. So I think our operating assumption is that it should improve. But I think from our point of view, I think ensuring that we can manage the business well on a constant currency basis and mitigate the forex risk is something we know. I think we're getting far better at that today than what we were 5 years ago.
And this translation doesn't, involve any cash flow. This is basically, converting from one local currency to Indian rupee.
Sure. Perfect, sir. Thank you very much.
Thanks, Bhavesh.
Thank you. The next question is from the line of Binoy Zariwala from Sunidhi Securities. Please go ahead.
Yeah, hi. Taking the Africa cluster point ahead, so as I understand, is it correct to understand that the entire wet hair manufacturing has been localized now?
Not the entire wet hair manufacturing. We have a tiered branding strategy. So for some of the phase 1 priority brands that comprise the bulk of the focus area, those have been localized. There are still a few smaller brands that are going to get exported from the US. Over time, as they gain more scale, we localize it. But for the first 2 or 3 brands that we are prioritizing, those have been localized manufacturing in Kenya, in Nigeria, and in South Africa.
Right. And with regards to the launches, so is wet hair launch already done in Nigeria and South Africa as well?
Yeah, so I think the wet hair launch is already underway in Nigeria and in South Africa, yes.
Okay. And last is on the HI registrations and the plans with the launch of HI in Africa, if you could share something on that.
All the groundwork in terms of registrations, etc., is underway. In terms of the sequencing, I think the focus for us in the immediate term is to ensure that the Darling brand gets relaunched, the wet hair scale-up is successful. I think once we have those under control, my expectation is that the next year we lay the groundwork. This year we lay the groundwork. Next year onwards, we'll start seeing some traction on the HI front. But again, from a focus point of view, we do want to ensure that the dry hair relaunch in the Darling brand and the wet hair scale-up is our main focus area this year.
Right. So next year means FY20 for HI, right?
FY20 would be the current assumption, yes.
Okay. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, that's the last question. I now hand the conference over to the management for their closing comments.
Thank you very much for your time. I think clearly on an overall basis for the year, we feel good about the sustainable and profitable and competitive growth that we have delivered. While the results for Q4 were quite mixed, we do believe that we are putting in all the building blocks in place to deliver a much stronger performance than FY19. Thank you for your time.